Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi everyone, Mason Clement here. Before we get into today's episode, I wanted to ask you one question. Are you sick of the wild swings in the stock market and ready to try something different? Did you know that investing in stocks actually put you at the very bottom of a company's capital structure, meaning that there's practically 0% chance that you're going to get any of your money back in the event that the company files bankruptcy? That basically you're putting yourself in the riskiest position for a questionable return. Personally, I hate the unpredictability and just waking up and having half of my investment gone when I didn't do anything wrong. So what a lot of people don't know is that you can actually make higher returns on a consistent basis by investing in the opposite end of the capital structure, which is actually the safest place to be, which is on the debt side in a first lien position. And you can do that by investing in real estate, and specifically investing with my company in notes that are backed by the land that we purchase. So if you're ready to diversify your income stream, go ahead and go over to scalablerei.com and click on invest in the top right corner. There you're going to find a form that you can fill out to determine if you're eligible to invest with my company, Celion Capital, and we'll be reaching out to you to schedule an introductory call and speak more from there. So thanks a lot, and let's jump into the episode. Hi, everyone. Thanks for joining another episode of Scalable Real Estate Investing. I'm your host, Mason Clement, and today we have Jeremy Friedman of Stoic Equity Partners, which is a commercial real estate investment company focusing on the industrial space in Southeast United States. So I thought it would be really interesting to have him on, especially as it's somewhat complementary to my land investing business. And I thought that there'd be maybe some synergies and some interesting things we could learn from it. So without further ado, let's jump into things. Jeremy, what's going on?
Hey, Mason, thanks for having me. It's a beautiful day down here in South Alabama, so I'm glad you had me on. Appreciate it. Look forward to talking real estate. I always love talking real estate.
All right, perfect. Yeah, I have a friend over there. You said he lives in South LA.
There you go. I'm in LA.
Lower Alabama, right?
That's it, Lower Alabama. We're in Fairhope and Daphne. We're on the eastern shore of Mobile Bay. So it's a beautiful area. We're actually the 7th fastest growing county in the country right now, Baldwin County, Alabama. So a lot of growth down here.
Oh, nice. Yeah, it's funny. I was actually working that market, Baldwin County, and for that same person I told you about, and then Mobile County. There's another investor looking to build RV parks around there. So yeah. I like the market a lot, and you probably know it a lot better than I do.
Well, I've been here for 20 years now, and so we and been in real estate in Baldwin County for 14 years. So yeah, we would love to, if you're around, love to work with you in the market some, or give you any benefit of any of my knowledge if you're doing any work in the market.
All right, so that sounds good. Yeah, I'm actually based in the Dallas area, so it's just a short drive, maybe still 10 hours or something, but not too far. Short flight, I'm sure.
Yeah.
Just jump over there. But yeah, why don't we actually jump into that? You said 14 years you've been in real estate. So what's kind of your journey look like, and what brought you into eventually starting Stoic Equity Partners?
Yeah, so I'll actually back up a little bit more. My first career, I like to call it, was in investment banking. I was a institutional bond broker for a capital markets group out of Memphis, Tennessee. And we were bought by SunTrust and did not want to move to the Atlanta market. They were changing some things around. And so I moved to now Fairhope, Alabama, where I live now. But this was about 20 years ago. And at that time, actually continued to work in the bond business for a different firm, but ended up starting a residential home building business. And it was with a partner that was supposed to really run the day-to-day, and I was going to run the office work. And long story short, ended up having to protect my investments and buy him out and really get into the home building business. And to put some perspective on it, we started in 2006, shortly before the 2008 crisis. So, it was quite a ride. I timed it perfectly. The home sales started to dip in third quarter of 2006, right when I got into the market. So it didn't obviously, come to full fruition until 2008. But through home building, we started in a capacity of building some production homes, and then ended up pivoting several times to more custom homes and what I called high performance, but they were actually green certified homes. This is pretty, back at the time when that was a pretty big movement. Built the first couple of green certified homes in the state of Alabama at that time. Just kind of kept pivoting until finally in 2011 ended up leaving, throwing in the towel with that, and went to work for a commercial real estate broker commercial real estate developer out of Tuscaloosa, Alabama. He was doing single tenant net lease retail development, and I worked mainly in the disposition. So they would develop, leases would commence, we would sell off the properties to investors. It had a lot of similarities to bonds, actually. So it was a pretty good fit. Worked with him for a few years, and then started out on my own in real estate brokerage. So again, focusing on single tenant net lease retail properties all around the Southeast. So I would represent lots of O'Reilly Auto Parts, Dollar General, CVS, Walgreens, Taco Bells, you name it. Pretty much from Virginia to Florida, right? And so along the way, I was with at a small regional firm here in Baldwin County called Bellator, and I was in their commercial department, and one of the other guys in the department, Grant Reeves, and I struck up a friendship. He went on to work at Marcus and Millichap in their hospitality division, hotels, selling limited service hotels to investors. And I went on to start Catapult Properties, a regional brokerage firm that we sold single tenant net lease, as well as some general commercial in the Baldwin County area. But Grant and I stayed in contact and always wanted to get on the principal side. And in 2020, when COVID made the phones stop ringing for a little while, we were able to get together and kind of hatch the plans for Stoic Equity Partners, which is a private equity real estate company. We syndicated our first 10 deals where we put together groups of investors and purchased. We started in self-storage. Our first 4 deals were self-storage. We did an adaptive reuse of an old grocery store box. We did a ground up development over in Pensacola, Florida. We did a very large expansion project in Little Rock, Arkansas, where we tripled the size of an existing facility that we purchased. And then we bought a fairly stabilized facility as well. So the market, especially as interest rates were rising, it became more and more difficult to make those self-storage numbers work. And we were having some concerns about supply in the markets. We are in a very fast growing region down here in the Southeast, but we're seeing so much supply. It was really hard to find anywhere to develop new. Cap rates were very low to acquire. Interest rates were rising in our face. And so we kind of, at that point, made a pivot to value add multi-tenant flex industrial properties, which is where we land. And maybe I've gone too far, but that kind of gives the background of where I came from and where we currently are with Stoic Equity Partners.
Excellent. Yeah, that's actually really helpful just to understand more context and background and what brought you to that. And so what had attracted you all to doing this flex industrial? And while zoning maybe for self-storage might be like maybe a light industrial, like how do they differ for someone that's maybe not familiar with all the differences and nuances?
So zoning is pretty similar, actually. I mean, we're not in a heavy manufacturing uh, type. These are multi-tenant, meaning in most of our facilities, the each suite is anywhere from say 1,200 square feet to say 5,000 square feet, and they're any configuration of office to warehouse. That's, we like to see less office, something less than 50% office space to 50 or more in the warehouse. So we call these the mullet of commercial real estate, right? These are, business up front. You've got a nice storefront where there's either office or showroom, and then in the back we've got roll up doors, dock highs, and it's all party in the back. I like to say, but we love the multi-tenant. You alluded to multifamily, and storage is also multi-tenant. We love multi-tenant assets from a vacancy risk mitigation. In other words, as you and your listeners understand, I'm sure that if we all constantly have tenants moving in and out of these facilities, and it doesn't hurt our cash flow. It's built into our models. In other words, we're not concerned when we have a tenant not renew. As a matter of fact, based on inflation and where rates are going, lease rates are going, we sometimes encourage our tenants to move out if at all possible. Or if they don't have renewal options that gives them a right to a certain rental rate, we try to move them to market rents, which is part of our whole thesis. So the other part is it's been, and this is very important from a land development play, but there's been very little flex industrial property developed. Matter of fact, it's the only major asset class in commercial real estate that has actually shrunk over the past 30 years. And the reason is a couple of it's NIMBYism. People don't want it in their backyard. So the municipalities are hesitant to approve it, but also, and probably the biggest factor is rental rates and construction rates just don't make it profitable to develop brand new property. So we end up buying facilities below replacement cost. Currently, our portfolio of what we own and what we have under contract, it averages out about $93 a square foot that we're buying these facilities, and current replacement value would be more in the 140 range based on bids that we've gotten to develop. And most of our rents at these facilities are in the single digits. So you take somebody paying a $9 rent, it doesn't really support a $140 construction cost or replacement cost, right? And so we're able to buy them below replacement cost. We are able, because again, we're in a growing markets, and so there's a lot of demand but very little supply and very little new supply. Now there's been tons of class A industrial built in the last at least, especially in the last 10 years, there have been a very significant supply of large bulk class A industrial, but multi-tenant flex, there really has been very little, and some of it has gone away because of redevelopment, and so we're able to push rents. We're able to push occupancy, push rents, and which falls into our whole value add thesis. And at some point, somebody's going to be able to develop it, and they're going to develop it, and that's going to help push rents a little more. So we think we're in a really sweet spot with buying value add flex right now. So
Okay. And how many tenants usually do y'all have in one facility or location?
So our sweet spot is between 50 and 100,000 square feet of space. And so we typically are ranging anywhere from say 20 to 40 tenants in that space, 20 to upper 30s. So we are buying a couple of larger facilities that have a few more tenants. We're buying 128,000 square feet in Louisville, Kentucky right now, that we're closing on this week, as a matter of fact. And then we're buying 158,000 square feet in the Jackson, Mississippi suburbs. So, and those do have more, but in general, our sweet spot's really that 50,000 to 100,000 feet. We're buying them from sellers who are legacy owners that maybe they're not really motivated to push rents. They're not motivated to maintain or improve on the property. So we're able to, we'll buy the property. We'll set aside some money to do any deferred maintenance or improvements on the property and help boost rents over time. Whereas a lot of those things, if you've got a legacy owner that they would have to draw out of their cash flow to do that, a lot of times they're disincentivized to maintain the property or improve the property. Whereas we can do that on the front end, help us get higher rates, which in turn helps us sell at a higher sales price, and so it works well for us. So we're and a lot of those owners are in that 50,000 to 100,000 feet. You get over 100,000 feet, tend to be more sophisticated owners that, which is fine. We like that. We love that product. But there's usually a little less juice to squeeze in that from a value add standpoint.
Okay, that makes sense. And so if I was a limited partner just trying to evaluate different investment opportunities and looking at, say, a self-storage facility, syndication, or maybe multifamily, or this multi-tenant flex industrial, what are some of maybe the pros and cons, or obviously the reasons why I should invest in this flex industrial over those other opportunities I'm looking at?
Well, so, I always feel like multifamily's got a huge, huge pro in investing in multifamily. I mean, people can do without self-storage. People can do without a lot of things, but they typically need somewhere to lay their head, right? And so I feel like that's a real pro when it comes to multifamily. The challenges I see right now with multifamily have been twofold. One is the rental rates have rose so quickly that I think they've really probably plateaued, if not going to see a little bit of decline in the short term. The long term, and it goes back to the '08 housing crisis, right? That homes were being built in the 1.3 million to 1.5 million units a year up until '08, and then they dropped to 500,000. And that's gone on now for 12 years, or 14 years now rather, and that has made it where there's a real undersupply of housing units nationwide. So I think I don't long term, I don't see any issues there for multifamily, but short term, I think there's two issues. One is the rental rates have kind of probably plateaued for a little while, and then whereas on flex industrial, I feel like we're on the early stages of that rise versus plateauing. And then the other side is a lot of the multifamily is done with floating rate and very short-term bridge type loans, whether they're either the value add or development. Those are typically using a bridge loan, variable rate, things like that. And that's really hurt a lot of people out there. But all in all, I think it's a very great product. Self-storage, I love the fundamentals of storage as well. And I just feel like currently you've got an oversupply in some markets and a lot of new supply continuing to come on. So back to where I was saying, hey, flex industrials actually shrunk. The supply shrunk over the last 3 decades. So if you think to self-storage and multifamily, that supply has rapidly risen in the last 10 to 20 years versus versus demand. I think it's probably gotten a little out of whack there for a while. And then with higher mortgage rates, people are moving around less. A lot of people are sticking in their home where they've got a 3% rate rather than selling it to move down the road or trade up. They'd have to, in a lot of cases, trade down if they sold their house and then refinance at a current rate, a new purchase. So that's slowed down the velocity of people moving around a little bit, which is hurting storage. But all in all, again, I think fundamental and long term, it's a great asset class, to be in. But for us, we see, and especially in these growing southeastern markets where you've got a net migration of people moving to the southeast, there is a very strong demand for more flex space. We're buying it below replacement cost. We're able to push rents higher. It's insulated somewhat from the work from home phenomenon that COVID exposed. And that's because if you need a warehouse, typically you're not going to be able to work from home, right? So, the next move down from there is having everything in your garage, and that just won't work for an HVAC contractor or a Terminex or these type of service companies that need an office and a warehouse. And so we feel like we're early in the trends on flex industrial. We do feel like eventually it'll turn into a development phase similar to what's been going on with self-storage. And we want to ride the trend. So
that makes sense. And you hit on it just a little bit a second ago, but what is like the kind of perfect typical customer profile that y'all have for the tenant profile that's using these spaces?
So it is a wide variety. We have everybody from national tenants such as FedEx and Tyson Foods and lots of national franchise such as Terminex or the IC Corporation. For some reason, we have them in multiple of our properties around the Southeast. So you've got the national tenants in there. And so the last mile people, JB Hunt, FedEx, those guys are in there. You've got regional and franchise people. We've got a lot of service providers, right? Moving companies, HVAC contractors, engineering firms, and then you do have a little bit more of the more traditional kind of office user, or because we tend to be the low price option in the market. In other words, flex space is typically cheaper to lease than retail or traditional office or any other space. So we're signing a lease right now with like a salon, right? That they're using one of the spaces that was more heavier built out office. Typically our MO is we go in and we tear out a lot of that office that's built out in these facilities and get it back to more of a 50-50 or even less office space, because that's where the demand is. But like I said, we just had a salon come along and liked the space as it was built out and taking it. So it's a real broad variety. I mean, we have real estate companies. We have several pharmacies that are not a retail pharmacy. We've got 2 facilities that have mail order pharmacies, and we've got 1 facility that has a pharmacy that they service all of the assisted living facilities in the state. And so they have their own vehicles that delivered all those facilities from this one, one facility. So again, it's a very broad spectrum of users that can use these and need this type of space.
All right. Yeah, that's definitely helpful. Actually, it's funny where I live in Richardson, just outside of Dallas. In my part of town, you have a lot of, I think what you're talking about, you have like some metal fabricators, Terminex actually just down the road, and those different people. So I guess obviously for like a metal fabricator, they got all this material and stuff. They got to do their work in there. And I guess for pharmacies, they need a place to store all that product that they're mailing out. So yeah, this makes a lot of sense for all these different use cases.
We always end up with a CrossFit gym, and we always, a lot of times we'll end up with salons, but usually it's more like we've got several like online boutiques where they'll ship clothes in and out, and they have a little space up front where they'll model the clothes and post it online. And so it's very interesting what all uses that people find for these spaces.
Okay. That makes sense. Yeah, I actually had another guy on my podcast. I'll have to put the link in the show notes or something. We were talking about industrial real estate space as well. And for him, he was also talking about like the weight of the equipment that's going in there. So you have to pay attention to like the thickness of the concrete and stuff. Do y'all get that granular for your properties, or how's that work?
Yeah, we have some that have very high clear height and larger warehouse space. And those in particular, we need to be aware of the floor thickness to make sure that fork trucks and or any pallet racking and storage, vertical storage, that there's enough thickness to handle that. But most of ours in the 1,000 or it's 1,200 to 3,000 square foot range. There's not really a scenario in say a 16-foot eave height. It's not really a scenario where they can get enough weight in that to become an issue. But a lot of our properties are built, concrete tilt wall construction and these are heavy duty built buildings. They're not, so yeah, but a 6-inch slab will handle a lot. So,
okay.
Something we run into a lot that should be of interest to you in the land world is people are always looking for yard space and also beyond that is just IOS or industrial outdoor storage, right? So a lot of people come to us and say, hey, I just need an acre of land fenced in and gravel to store vehicles or materials on, and which is a great covered land play use for land and we're seeing a lot more demand for that. In most of the markets we play in, which are kind of these secondary markets in the Southeast, so like Jackson, Mississippi, Birmingham, Pensacola, Little Rock, in a lot of those markets, there tends to be a lot of land. And so we kind of are a little, there's not a lot of land entitled for iOS, but those are some good plays, I think, that could be of interest to people in the land game.
Excellent. Yeah, that's actually what I was about to ask as well. And also, so that piggybacking on that, this location, what would you think, besides like being next to an interstate highway, what are some other good locations to choose?
Certainly access from the transportation lanes, like you mentioned, being near an interstate or a highway where trucks can easily get in and out of. tends to need to be isolated from the residential areas. In other words, it needs to be close enough that, especially in our flex world, we want to be in and around those affluent suburbs, because it tends to be the owner of the HVAC company lives in that suburb, and they don't want to, drive a long ways to their office, right? So we try to locate, we try to buy properties located in affluent suburbs, but there's usually a geographical or some other way that they're kind of isolated from those areas, just so that you don't anger your neighbors, right? And then in iOS, it would be the same as well. You don't want trucks coming in and out at 5 a.m. Right next to an affluent neighborhood. But probably not going to get it entitled for that next to an affluent neighborhood anyway. But that's always a concern, is you don't want people coming and going and disrupting the neighbors. But main thing is access. Where's the most convenient for trucks and commercial traffic coming in and out.
Okay, that makes sense. Yeah, that reminds me of, there was a parcel I was looking at near San Antonio by I-35, and the biggest problem, though, I really needed to do an assemblage where I get the adjacent parcels, and I tried, but was not successful in that. But I say that because it was so narrow. Like, some of the people in the trucking business were saying, well, that turning radius is going to be so large, you got to keep that into mind as well. You probably have to do a traffic impact analysis, maybe spend $500,000 installing traffic lights or something, or I don't know. But I say all that too because this was just actually the northern tip of it was in city limits, but it seems like it'd be easier to entitle things that were either in the ETJ or county level. What do you think?
Historically, I would agree with you, but just having dealt with some of the counties recently, such as Baldwin County and Escambia County in the Panhandle of Florida on development projects, it seems like they have gotten just as tough, if not tougher, to deal with than some of the city municipalities that we've traditionally dealt with. Certainly there's wisdom of, for instance, in Baldwin County, there are still unzoned areas where, they don't have the right to tell you can't use it for a certain use, as long as you comply with the parameters of that use in the zoning ordinance. So as long as you build it the way it should be built, they don't really have any rights to tell you. But there's been a huge push to zone areas that have historically been unzoned in Baldwin County. And so we've seen, 6 or 7 districts in the last 2 years become zoned. And I blame Dollar General, because that's typically what happens. Dollar General goes and locates in an unzoned area on the corner, and all the residents get up in arms, and then they vote in zoning in that district. And then, so I blame Dollar General and apartments. Let me put that, multifamily. Those two tend to get the residents up in arms, and they want to vote in zoning. And a lot of times I think it's foolish. They don't realize how badly a lot of times they're hurting their land values. I've seen some really poorly zoned properties that are going to come back to bite those people in the long run. And typically it's funny, we see it that there'll be an unzoned area that a lot of developers will move in and build some neighborhoods. And then those people in the neighborhoods don't want more neighborhoods built next door. And so they come in and they vote in zoning. It's kind of like, I got my piece, I'm gonna close the door behind me. But anyway, that's a whole neither here nor there. But we did just have a very long entitlement process for a storage facility in Escambia County, just on the outskirts of Pensacola. And so, historically the counties have been a lot easier to deal with, but lately it seems like they've sharpened their claws as well. Now, obviously, the more rural you get, the counties and even the cities are easier and easier to deal with. But in these higher growth areas, I think there's a lot of people trying to slow down growth, and they've perfected the slow walk through the system to where you may get your entitlement, but they're going to slow you down as much as possible to get through there. But
So what's the typical time frame you expect?
It's very, very market dependent. In Escambia County, we had it took us 18 months from contract to approvals on that self-storage facility. Part of that, I'll take part of that on, and part of that was the fact that we were using an engineer out from outside of that market, and they were reading the ordinance, the tree ordinance specifically, in such a manner that we felt like we were doing the right thing. And what we didn't know is the local market, there had been some conversation going that basically made the county less incentivized to be willing to let people take out heritage trees that they in years past had been allowed to remove. So we had to kind of go back and redesign and do some things and go back through. But I mean, there were times where we're again back to the slow walk. I mean, like where we just couldn't get anybody's answer, and you've got 5 different departments have to sign off, and you got a couple of departments that just won't even respond, and it's been a mess. But that's 18 months, and then on the flip side, I'd say on the short side, it's 90 days. But that's for a slam dunk. It's entitled for what you need it to be. It's not requiring a site plan approval by the city council or planning commission. So if you've got a site like that, it's at least 90 days just to get drawings in and applied for and approved. But so it's very market dependent. What are you running into timeline wise?
Yeah, for like those land entitlement projects, we expect something like 12 to 18 months at least on average. So it doesn't shock me at all. Although I've heard in like the West Coast, they like to make it even more difficult and even more expensive with all these fees and processes. Like it might take 18 months just to get the first thing approved. Then you still got like another year or two or something. So I definitely try to avoid stuff like that. But that's why I like Texas markets. I'm very biased, obviously, living here, growing up here. But I have heard that generally we're a little more friendly, other than Austin. I heard Austin has become a lot more difficult. And there's a liberal bubble anyway, so they've always been a different thing to deal with. But I have heard recently, like Dallas County has just become so overwhelmed with applications overall that they've gotten a little slower too. But I don't think they give you quite as much trouble in getting it approved. It's just the resource limitations.
Now, Houston has no zoning. Is that right?
Yeah, exactly. Houston's weird like that. They just kind of base it based on what's surrounding there. And the main thing there too is like the floodplains and flood insurance requirements, stuff like that. So I know some people just pass on that market entirely, but then they're overlooking certain opportunities. So yeah, everyone's got their preferences. But yeah, I mean, on a national scale, at least for like single family developments, it's like right up there with Dallas, like number 1 and 2 spots for like 100 and 200 lot subdivision type things. These national builders are building.
Gotcha.
So definitely on the map. Yeah. There was something else I was going to ask, and it's the financing you mentioned for multifamily, the bridge loans, these variable rates that are getting ratcheted up, obviously as rates have gone up. What's the usual financing that you do on your projects?
So most of our investments have a lifespan of 5 years is what we're shooting for. So we get fixed rate debt for 5 years. We use a variety of bank financing, some CMBS. Now the CMBS is 10-year, and then we're currently about to close one with a life insurance company loan. But all of those, except the CMBS, are 5-year fixed. We try to push our amortization out to about 25 years. And we look, depending on how heavy of a value add lift we have, we try to get, a year or two of interest only period while we're, making renovations to the property and turning over the rent roll and things like that. So, we're right now we're assuming a CMBS loan at a 485 rate. We're originating a new life insurance loan right now at a 585 rate. And then we're seeing bank financing currently, in the 8% range, give or take, depending on who it's with and what their appetite is for the loan. So, but we do fix all of our rates. There could be an argument right now that it's maybe now's the time to float. Maybe you see lower rates moving forward, and while I certainly believe there are some lower rates that'll have to come, we just not seeing enough delta between the fixed and the floating rate to make it worth taking that risk on. And if rates move down substantially, we try to, other than Lifeco and CMBS, we try to make it where our bank loans don't have any prepayment penalties and we can refinance. So we've never taken on a floating rate debt at this point.
Okay.
Yeah.
Yeah, I imagine that it reduces a lot of heartburn and anxiety in terms of just the underwriting. It's going to work because you underwrote it at that number, so it makes sense.
Yeah, I will point out probably one of our biggest challenges at the moment is insurance, especially in our coastal properties. Wind has gotten to be crazy. Now, most of the industrial properties are net lease, at least double net, or if not triple net, and therefore we can, pass that through. But it still becomes an issue. You don't want that load on your tenants either. It kind of limits how much base rate rent you can get. But on storage that are gross leases, we're pretty much having to eat that. Although we feel like it'll translate through to rate eventually. And, the way we look at interest rates is similar to the insurance rates at the moment. Is if we can make the deals work today, we feel and lock in our rates, we feel very comfortable that they'll continue to work. A, our interest rates are locked in. B, we kind of had a similar situation with insurance rates after Hurricane Katrina. A lot of the carriers pulled out of the market. Rates went sky high. It was a long, nearly 10-year long process, but eventually new carriers moved into the market to, I won't say predatorily, but they, come in at these really high rates. So that draws them in. You get a couple of years without a large storm. People move back. More carriers start coming in. You get some competition back in the market, and it settles down and comes back down. So we kind of feel like we're in a very similar. We're in that stage where they're kind of plateauing right now. But we've had properties that insurance has gone up fourfold in 2 years. So they've doubled twice in 2 years period, which is, I don't know if you guys are seeing that in Texas at all. I know Louisiana is having issues. Florida's terrible. I read about California's insurance problems, but we're seeing some pressure on our inland properties, but the coastal stuff, the cat stuff is in particular, we're having issues with insurance. But we kind of look at that same as the interest rates. If we can make them work at today's rates, we feel really good about them moving forward.
Okay. Yeah, I've heard that it's been a similar issue with multifamily deals as well. Just trying to underwrite that with the increase in insurance. Just like overall inflation, just like if they have to pay to replace a roof or something, like the cost of that material has gone up dramatically as well since, I guess, a few years back, like you said.
Which you're right, which is the difference from what we saw in Katrina. With Katrina, it was just a risk of loss that they had, and so they wrote the rates higher. what we're facing now is the risk of loss, and they're quoting higher rates, but they're also having to increase the TIV, the total insured value of the properties, because of replacement costs having gone so high. So it is kind of a double whammy, and we do not believe replacement costs, material and labor costs are going to come down significantly. They may plateau, they may have a little bit of retracement, but we feel like once they get up there, they might come down a little bit and settle down, but we don't foresee that. So the TIV part, the replacement cost part of the insurance is an issue that won't be fixed by competition. So that there'll still be some issues with insurance. So like you're right about that.
Yeah. I mean, when prices go up, they're not ever really going to go back to like 1950s values or something. Prices are just up.
Yeah. I mean, we saw a pretty good decrease in construction costs, in 08 through 10, but don't see that coming anytime soon. And we're way higher than that now. So we may get some relief, and I hope it does settle into a more more stable market rather than what it's been. And some materials are still very difficult to get. We hope to see some relief there, but we don't expect to see a lot.
Right. So. That makes sense. Okay. One of the last questions I wanted to ask is the tax implications investing as an LP. Is it the same as like multifamily, or are there any other additional advantages?
Very similar to multifamily. We do cost segregation studies on all of our properties when we acquire them, and we have a lot of the same bonus depreciation abilities as multifamily does. So we'll take all the bonus depreciation that we can. Obviously in 23, that got limited down to 80%. In 24, it would be 60%, although there is a bill making its way through now that would reinstate the 100% bonus depreciation back and retroactively to 23. So we're waiting to file our 23 taxes to see if that bill makes it through. But we take a good bit of depreciation in year one, all the bonus depreciation that we can in year one, and that all passes through pari passu to all the LPs. So yeah, it's a big tax advantage. That's a big tax advantage of real estate in general, right? So not so much land, but improved real estate. We take as much depreciation as we can. One other item we're looking at right now is the 179D tax deductions that are available. Those have to do with energy efficiency. And I'm really not an expert on this, but basically I think they go back to the 2006 energy code. And as long as your building is improved beyond the 2006, I believe it's the 2006, don't quote me on that, but energy code, then you can take these deductions, and it's a per square foot deduction. And then recently they juiced that up with a whole addition to that law. So it's gotten to be where, you can take between $1 and $3. And again, don't quote me on this, deduction. And it's a depreciation. So it does go against your basis. And, we're looking at that. The problem we've run into currently is we haven't found a provider who's willing to do those reports at a cost that makes it worthwhile. So we're working on that, but that's another way we're looking to pass through additional depreciation to our LPs.
Okay, very interesting. Can you explain the bonus depreciation a little bit more, like the benefit behind it? Because right now, just from a high level, I would just think from a time value of money perspective, you're just offsetting even more income. But what if you're already like showing kind of negative income from like the cost segregation? Why do you need that bonus depreciation and all that?
Well, so if I understand your question right, Mason, you're asking why would you need more depreciation if you're already at negative, but based on the cost seg?
Yeah, is it like the value of like carrying that loss forward to apply to future income streams?
So I would say it's two things. One is it allows our LPs and our investors to offset other income, other passive income that they have. They can use, so if we continue to pass through more losses, they can use it to offset not only the income they're receiving from our quarterly distributions, but they can use it to offset other passive income, right? And that income would be taxed at an ordinary income tax bracket, based on their tax bracket as ordinary income. We're going to defer that out for, in our case, 5 years. Our investments are 5 years. And 5 years from now, then we do have to recapture that, but now we recapture it at 25%, which is below what any of our investors' tax bracket would be. So we're deferring the taxes. We can defer not only the income that they receive from our investments, but income they receive from other investments, and then we're converting it to that deferred that 25%. So that's kind of the benefits we see in it. The bonus depreciation comes in. I'm not sure if this was what you're asking, but the engineering study on that cost segregation, they go in and they put all the different items in the building, all the improvements, including paving and everything, and they put them in different buckets. And the current code says that we can take the 5, 7, and 15-year buckets, the stuff you would normally depreciate over 5, 7, or 15 years, and take it all as bonus depreciation. Or again, it was 100% in year one. Last year, 23, it went down to 80% in year one, and then now in 24 it'll be 60% in year one. So you can take all that and depreciate it all in year one. So what we typically our investors receive, at least the first year, most every year, they receive a K1 that says they lost money that they can use to offset other income, even though they received income from us. So
that makes sense. Very interesting. Yeah, we'll see. Maybe if Trump gets back in office, we'll see even more drastic changes to the tax code.
Maybe, it's funny. I know that there's been a lot of talk of Trump's tax returns and how he was actually losing money and all, and how, he's not a great business person. And it always cracks me up. And I think, well, you really just don't understand real estate, because that means he's a great business person and he's actually deferring his taxes, even though he's making money. So, anyway, but we'll see. But there is a bill working its way through right now that would reinstate the 100% bonus depreciation through to and reinstate it back into 23. So I think, if I'm not mistaken, it's already passed the House and it's working its way through the Senate. So we're hoping that it gets passed. Although I hear there's a bunch of garbage in that bill that we would probably not want to be passed, but I guess that's the way of Washington, right? It's a little give and take.
Oh yeah, definitely. Just back to the 25% being like lowest tax bracket in the back end when you have to recapture. Why is it at the lowest tax bracket, or at least like the lowest for your investors?
Well, so the lowest tax bracket would be long-term capital gains. So it's not the lowest. So, but depreciation recapture, for whatever reason, they assigned it 25%. So depreciation recapture is 25%. Now, if we hadn't depreciated it and we weren't for all the portion that's not depreciated that we actually get a gain on that was not depreciated, that goes into the long-term capital gains bucket, and that is even lower, whatever 18% or whatever it is now, I forget, 20%, 18%. But ordinary income is taxed significantly higher than both of those, right? Depending on your tax bracket, it can be 30, 35, 37%. So by converting any of those, what your taxable liability from that higher tax bracket down to a lower tax bracket has benefit, and then moving that tax liability down the road also has benefit.
Okay. Interesting. Yeah, I'm sure there's a whole other Pandora's box that we're opening in terms of all of the tax implications. But that's helpful to overview and understand, at least.
Yeah. And I guess this is where I should say I'm not an attorney and I'm not a CPA. So do your own research. But most of our LPs want as much depreciation passed through as possible. So we do what we can to do that. And like I said, on the cost segregation studies, it's very cost effective. Those studies are, we pay a very small percentage of what the depreciation we can pass through is. On the 179D studies, we're being quoted like 10% of whatever that depreciation is what they want us to pay them for the report. And so that kind of offsets that difference between the recapture of 25 and maybe a 35 tax bracket gets offset with what we'd have to pay for that report. So we're still scratching our heads on, does that really work? Is the juice worth the squeeze at that point? So.
Oh yeah, that makes sense. Like maybe they're hoping that people don't, certain customers that don't do as much thinking about it and just pay them. Just close the eyes and sign the invoice and pay it.
I mean, for some people, just pushing the deferring the liability out 5 years is worth it. So maybe, maybe it is worth it. But for us, we try to look at it holistically from a total return, of that expense. And of course, you can deduct the cost of those reports. So there's that. So, so we're still scratching our head. That's TBD. We're still working on that, and whether or not that will be a strategy we use.
Okay.
But the cost segs are pretty much automatic for us. So yeah, I mean, I think we've had one property we didn't do a cost seg on. It was due to its size, and then we had several people in it that were actually in a 1031 exchange, so their basis was already eroded, and so it just didn't make sense to go after the bonus depreciation on that one. It was a smaller deal anyway. But other than that, we've done cost segs on all of our properties.
Okay, perfect. Well, I think that we've hit on most everything I wanted to discuss. So What kind of person are you looking to get in touch with, and how could they get in touch with you if they want to learn more and connect with you?
Right. Well, I love, as you can tell, I love talking about any real estate all the time. So I welcome anybody get in touch with me. My email is jfriedman@stoicep.com. Stoic EP like equitypartners.com. And then I'm on LinkedIn as well. I was a New Year's resolution to get off of Twitter, so I was spending too much time on X, I should say. So pretty much LinkedIn and email is the easiest way to hit me up. But we are actively raising a fund. It's a $25 million in equity fund. We're at $7.5 million on our raise. So we're actively looking for LPs. Our minimum check size is $50,000. And we'll continue to raise and deploy that capital throughout 2024, and then that window will shut, and we'll start fund number 2 at that point. So we started with 10 syndicated deals, deal by deal. We've just launched this fund, and we're about to close on the first 2 assets in that fund. So it's not completely blind. We do have assets in there. But we'd love to talk to anybody interested in investing in flex industrial. So,
all right, excellent. Is that usually 506C offerings?
This is a B. We've usually did C. This one's B, so we could talk about it a little more and do a little bit more marketing behind it.
Okay, yeah. Got it. That's helpful. All right. Well, yeah, I'll put all that in the show notes, and hopefully this was helpful for everyone. I found it very interesting myself. So thanks a lot for jumping on the show.
Yeah, very good. I enjoyed meeting you, and appreciate you having me on.
Hey guys, I appreciate you taking the time to listen or watch this episode. As you might have noticed, we don't run ads, but what I would like you to do is just subscribe to our YouTube channel. That would help us out tremendously. You don't even have to leave a review, but if you do feel like you would gain a lot of value from this episode, feel free to share it with your friends and comment, like, subscribe, all that. But subscribing to YouTube would be what helps us the most. That's the only thing I ask. Thanks a lot. And if you do want to get in touch with me, feel free to email me at mason@scalablerei.com. Thanks a lot.